Hey everyone, and welcome back to the channel. If you're looking to supercharge your trading strategy and gain a real edge in the markets, then you're in the right place. Today, we're diving deep into one of the most fundamental yet often overlooked tools in technical analysis, the volume indicator. Trust me, understanding volume can transform how you see market movements, moving you from simply watching prices to truly understanding the power behind them. Many traders focus solely on price action, where a stock or currency is going. But what if I told you that knowing how much conviction is behind that price movement is just as, if not more, important? That's exactly what a volume indicator helps us do. It measures the number of shares or contracts traded over a specific period. Think of it like the engine powering the price. A big engine means a lot of power. A small one might just be coasting. So, why is volume so crucial? Well, it essentially acts as a confirmation tool. When you see a strong price move, whether up or down, and it's accompanied by high volume, it signals that many participants are actively buying or selling, giving that price move more credibility and strength. Conversely, if a price makes a big move on low volume, it might just be a blip, lacking true market conviction. This distinction alone can save you from countless false signals. Let's start with the basics of how volume is displayed. Most charting platforms show volume as vertical bars at the bottom of the price chart. Each bar corresponds to the trading period of the candlestick or bar above it. Often, these bars are colored, green for periods where the closing price was higher than the opening, and red for periods where it closed lower. This visual cue immediately tells you about buying versus selling pressure during that interval. The most straightforward interpretation is this: high volume confirms a trend. If a stock is trending upwards and you see increased volume on the upswings, it suggests strong buying interest is pushing the price higher. Similarly, in a downtrend, high volume on the downswings indicates aggressive selling pressure. This isn't just theory. It's the market speaking through collective action. Now, let's talk about divergences. This is where volume really starts to get interesting and offers powerful predictive insights. A divergence occurs when price and volume move in opposite directions. For example, imagine a stock reaching new highs, but the volume on these new highs is steadily decreasing. What does that tell you? It suggests that fewer and fewer people are willing to push the price higher at these elevated levels. The buying enthusiasm is fading, even if the price is still climbing. This could be an early warning sign of an impending reversal, or at least a slowdown in the uptrend. On the flip side, consider a stock dropping to new lows, but the volume accompanying these lows is also decreasing. This might indicate that selling pressure is exhausting itself. Fewer participants are willing to sell at these lower prices, suggesting that the downtrend might be losing momentum and a bounce or reversal could be around the corner. Catching these divergences early can be incredibly profitable, helping you avoid traps and identify potential turning points. Beyond simple observation, there are several popular volume indicators that analyze volume data in more sophisticated ways. One of the simplest and most widely used is the on-balance volume, or OBV. This indicator accumulates total volume, adding it on up days and subtracting it on down days. The idea behind OBV is that volume precedes price. If OBV is rising, it indicates that smart money is accumulating, and price should follow. If OBV is falling, distribution is occurring, and price is likely to decline. Another fantastic volume indicator is the volume-weighted average price, or VWAP. This isn't just about showing volume. It's about showing the average price a stock has traded at throughout the day, weighted by volume. Think of it as the true average price considering how much trading activity occurred at different price points. Many institutional traders use VWAP as a benchmark. If a stock is trading above its VWAP, it suggests buyers are in control. If it's below, sellers might be dominating. It's an excellent tool for intraday traders to gauge market sentiment and execution quality. Then we have the accumulation, distribution line, or AED line. Similar to OBV, the AED line tries to determine whether a stock is being accumulated bought or distributed sold. It does this by taking into account the closing price S relationship to its daily high and low, and then multiplying that by the volume for the period. If a stock closes near its high with strong volume, it contributes significantly to accumulation. If it closes near its low, it contributes to distribution. Again, divergences between the D line and price can offer powerful clues about future price movements. Let's talk about how to integrate volume into your trading strategy. First, always use it as a confirmation tool, not a standalone signal. Combine volume analysis with other tools like price action, support and resistance levels, and other indicators like moving averages or RSI. For instance, if a stock breaks above a strong resistance level on unusually high volume, that's a much more reliable breakout signal than one that occurs on low volume. Second, pay attention to volume spikes. A sudden surge in volume often accompanies significant news events, earnings reports, or key market turning points. These spikes indicate a high level of market interest and can signify the start of a new trend or the exhaustion of an old one. For example, a large volume spike after a prolonged downtrend, especially if accompanied by a strong upward price rejection, could signal capitulation and a potential bottom. Third, consider different time frames. Volume behaves differently on a 5-minute chart compared to a daily or weekly chart. High volume on a shorter time frame might just be noise, while high volume on a longer time frame holds much more significance for trend confirmation. Always align your volume analysis with the time frame you are trading. Now, let's explore some practical examples. Imagine a stock in a strong uptrend. You're looking to buy on a pullback. When the price pulls back to a key support level, you want to see decreasing volume during that pullback. This suggests that fewer people are interested in selling at that level, indicating that the pullback might just be a temporary correction. Then, if the price starts to rebound from that support, you'd want to see increasing volume on the bounce, confirming renewed buying interest and a continuation of the uptrend. Conversely, let's say you're looking to sell a stock in a downtrend. If the price rallies back up to resistance level, you'd want to see low volume on that rally, suggesting it's a weak bounce. Then, as it hits resistance and starts to turn down, increasing volume on the move lower would confirm renewed selling pressure and a continuation of the downtrend. It's also important to understand that context matters. What constitutes high or low volume is relative to the specific stock or asset you're retrading and its historical volume patterns. A stock that typically trades 1 million shares a day might find 500,000 shares low, while a penny stock might consider 100,000 shares incredibly high. Many platforms include a moving average of volume on the indicator itself, which helps you quickly identify whether current volume is above or below its typical levels. Another common pattern to watch for, volume climax. This occurs when there's an extraordinarily high volume bar, often at the end of a long trend. If it happens at the end of an uptrend, it's called a buying climax. Everyone who wanted to buy has bought, and there are no more buyers left to push the price higher, leading to a potential reversal. If it happens at the end of a downtrend, it's a selling climax or capitulation. Everyone who wanted to sell has sold, and sellers are exhausted, often marking a bottom. These are powerful reversal signals, but they should always be confirmed with subsequent price action. Remember, volume is essentially the fuel for price movement. Without fuel, even the most promising-looking trend can fizzle out. By paying attention to volume, you're not just looking at where the market is going, but understanding how it's getting there and whether it has the momentum to continue. It adds a crucial dimension to your market analysis, helping you make more informed and confident trading decisions. Mastering the volume indicator takes practice and keen observation, but the payoff is significant. It's not just about looking at a single bar. It's about seeing the story that volume tells over time. It helps you distinguish between genuine market conviction and mere speculation or noise. So, next time you pull up a chart, don't just look at the price. Cast your eyes down to the volume and listen to what the market is truly telling you. That's a wrap on our deep dive into the volume indicator. I hope this session has illuminated just how powerful this tool can be in your trading arsenal. If you found this video helpful, please give it a big thumbs up, share it with your trading buddies, and don't forget to subscribe to the channel for more insights and strategies that can help you navigate the markets with confidence. Your support means the world to us. Happy trading, and I'll catch you in the next video.